Is Medical Properties Trust a buy or a sell? Let's get started with the model. This is a mid-cap company, 2.7 billion market cap. They're trading at $4.51 a share, and they have 600 million shares outstanding. MPT is a REIT that acquires and develops hospital facilities. They are one of the world's largest owners of hospital real estate with 435 facilities, 42,000 beds across 31 US states and 9 countries. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year, although it's going down, cut in half from 800 million to 400 million. Amazing margins. They convert over 50% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That looked fine in 21 and 22, a good size negative in 2023, a huge negative in the trailing 12 months. Lots of write-downs, lots of impairments. Revenue is a sales for the company, and that also got cut in half from 1.5 billion to 700 million. The main reason for the decline is one word, Steward. S-T-E-W-A-R-D. We'll talk more about that company when we look at their financials later. Since their stock price has come down a lot, their yield has gone up. Their yield is 7%, and they can afford it. They can cover their yield 2.1 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6 billion. We divide that by 600 million shares. And we get a calculated stock price of $10. They're trading at $5, so they're trading at a 54% discount. It's a buy according to the model, but it's a really risky one. They're going through lots of troubles. So what do you think? Do you think it's a buy or a sell? There are 17 companies in the same industry as MPW, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. Their capex is negative. The reason their capex is negative is because they sold a lot of properties. So instead of spending money on capex, they got paid. You can't scale and grow your company if you're selling it. So in the long run, you have to spend in capex. A pretty high debt to equity ratio, 1.5. For every dollar of equity, $1.50 of debt. Look at Strawberry Fields REIT, 75. MPW pays a really high dividend, but there's 4 companies higher on the list. A 10%, a 9%, a 7.3, and another 7.3. CHCT is Community Healthcare. Really small company, 68 million market cap. They generate 400 million of free cash flow, a little more than the average. They ranked 9th in market cap, 2.7 billion. They used to be a lot higher. Really good price to book. Investors are paying 40 cents for $1 book value. If a price to book is below 1, this implies the company's worth more in bankruptcy than as an operating entity. We can't look at their PE, negative earnings. Look at that price to free cash flow, 1.4. You rarely see it this attractive. Just based on that alone is a screaming buy. Price to sales 3.7, they're trading at 4 times revenue. The way that's calculated, it's market cap 2.7 billion over revenue 700 million. So this means their market cap is 3.7x their revenue. And the reason people are selling the stock is because their revenue is going down. Their 5-year annual revenue growth rate is negative 1%, the only company with negative on this list. If you put $10,000 into this company 10 years ago, you'd be really sad. At $7,000 today, a 31% total loss. That's assuming you reinvested the dividends back into the stock. So to summarize, I have them trading at a 54% discount, ranking 3 out of 10. I think it's a bit risky. I would not buy it 1 out of 10. Possibly for a swing trade, but for long term, I would not. Ratio 7 out of 10. That price to free cash flow is really attractive. Financials 2 out of 10. They look awful, going down so much year after year. Here's a stock price the last 5 years. In the beginning of 2022, it was $25 a share. It's pretty much only gone down since then. It was around $3 at its lowest point in the beginning of this year. It's come up a little since then. The main reason it's come down is because of Steward Healthcare, their biggest tenant. Steward filed bankruptcy this year. If they file Chapter 7 bankruptcy, that's liquidation. That's a big issue. They file Chapter 11, which is restructuring. So it doesn't mean they're going out of business, but they may not be able to pay their bills in full. So MPW may only get like 50 or 60 cents on the dollar. So they may have to take a steep haircut. MPW owns 10% of Steward. Right here they mention Medical Properties Trust owning 10% of Steward. And the way Steward was able to scale and grow was because of MPT. So the way it works is Steward purchases hospitals, then sells the real estate back to MPT. And then Steward leases the real estate from MPT. That's a great formula as long as Steward can pay the lease payments. And that's the issue. They defaulted. MPT is scheduled to release earnings on November 7th. So the latest info we have is as of the second quarter, as of June 30th, 2024. So let's go through the presentation slides so we understand more about the company. So you can see they're located all around the world, many locations in the US. It looks like there may be some in Mexico and a few in South America. I can't tell what country this is in, probably Colombia, because that's the northern part of South America. This is definitely the UK, that's Spain, I believe. This is probably Poland and Germany, and right here is Finland. So they have facilities all over the world. 435 properties, 53 operators. Steward is one of those operators. 42,000 beds in 31 states and 9 countries. So a pretty big reach. If you want to analyze REITs, you should understand FFO, funds from operations. The calculation is net income plus depreciation, amortization, minus the gain on the sale of real estate. Their FFO for the second quarter is negative 90 million. Last year was positive 339 million. It's because they had this big net loss. We'll look at their income statement to try to understand what that is. Their normalized FFO is positive 139 million. When you normalize it, you add back some things. They're adding back non-cash fair value adjustments. This may be due to interest rate hedges. I'm sure they'll talk more about that in the 10K. We also add back 49 million of impairments. So 2024 is a rough year for this company. The stock started coming down in 2022, but then it cratered in 2024, dropping even more. REITs need to take on a lot of debt to grow their business because they give most of their cash flow back to the investors in the form of a dividend. So here's their debt summary. A 2026 credit facility for 700 million. The rate is between 5 and 7%. A 7% term loan for 200 million. They have a loan in British pounds. That's for their UK facilities. That's 750 million, a really low interest rate, 2.3%. They have a few loans in pounds and euros. We saw earlier they have locations all over Europe. So total debt, 9.4 billion. 91% of their debt is fixed, 9% variable. Variable means the interest rate changes, usually based off a benchmark, like SOFR. They talk about entering into an interest rate swap in order to fix the variable interest rates. Remember earlier I mentioned swaps when looking at their adjusted FFO? Actually, it's normalized FFO, not adjusted. I mentioned the swaps when I talked about the fair value adjustment, the 159 million right here. It doesn't look like any debt matures next year, but 1.3 billion in 2025. Their free cash flow in the trailing 12 months was 400 million. So that's 3 years of free cash flow. So they really need to bring that number up in order to cover these debt payments. Most companies don't pay the debt when it's due. They take on new debt to pay the old debt. But if they're not generating that much free cash flow, it may be hard for them to get new debt to pay the old debt. Or if they do get new debt, they have to pay a really high interest rate because they're going to be high credit risk. Half their debt is in US dollars, 35% in pounds, and 15% in euros. Their net debt, which is debt minus cash, is 8.2 billion. EBITDA 1 billion. So their debt to EBITDA is 8. That's really high. You'd like to see below a 3. Obviously, the lower the better. But this should raise some alarms. That means they need 8 years of EBITDA to pay their debt. Their interest coverage ratio is 2.6. The calculation is EBITDA over interest expense. So 257 million of EBITDA over 99 million of interest expense. So it looks like they're just taking the quarter EBITDA because their annual EBITDA is 1 billion. So 257 million is just for the quarter. So the 99 million is their interest just for the second quarter. So they can cover it 2.6 times. So they're not in bankruptcy yet. They can cover the interest payments. The way a company goes into bankruptcy is when they can't pay the principal or interest payments on their debt. Here's a list of when their leases mature. So they have 1.3 billion of lease payments due to them, 10 million under 1% barring this year. So that means they need to find a new tenant unless they can keep the current tenant. Most of their leases expire after 2033, so they have a pretty long runway of cash flow coming in. The cash flow was cut down a lot from Steward. Here's a breakdown of their properties. The 435 properties, 189 million is general acute care hospitals. Acute care hospitals focus on short-term medical treatment. Regular hospitals have a broad range of services, including long-term care. Post-acute care follows general acute. So after exiting a general acute care hospital, a patient may go to a post. If you're in this one, acute care, it's more serious. Something needs to be treated. Post is meant for a patient after they become stable. And they have freestanding ER. That's an ER that's not attached to a hospital. 60% of their assets are general acute, 15% behavioral, post-acute 10%, urgent care facilities 1.5%, other 12.7%. I wonder what the other is. They do footnote it right here. This includes their investment in PHP Holdings. That's a managed healthcare company they're invested in. 2/3 of their revenue is general acute care hospitals, 20% behavioral, 13% post-acute, and 2% freestanding. They don't generate revenue from their investments. That's listed as other income or expenses on their income statement. Steward is their biggest operator. That's 1.9% of their assets. Circle Health is second, 1.2%. I hope Circle doesn't default. So this 1.9% is 1.9% of the total assets on their balance sheet. So it includes everything, goodwill, cash. But Steward is 17.5% of their total assets of all the operators. And you can see their revenue went down. It's 20 million. Circle is much bigger in terms of revenue with the same properties and with less assets. Texas has 51 properties. That's 9% of their total revenue. California is 14% of their total revenue with only 18 properties. Those must be really big properties. UK is 1/3 of their revenue. Germany 4%. Then you have Switzerland, Spain, etc. They list their EBITDA multiple for their tenants, except Steward. Steward's NA. You want an EBITDA multiple at least 1, but the higher the better. You want your tenants to be able to pay their lease payments. And they footnote Steward, it's footnote B. Coverage not available due to restructuring. They're going through the bankruptcy restructuring process currently. Vibra Healthcare is pretty low, only 1.1. So that's a little concerning. The RM and EBIT arm is rent and management fees. So it's earnings before interest, taxes, depreciation, amortization, rent, and management fees. The way to calculate that, it's EBIT arm over their rent payments. So Surgery Partners can cover their rent payments 7 times with their EBIT arm. So they're in really good shape. Here's their income statement, second quarter of 24, second quarter of 23. Revenue is down a lot from 337 million to 266 million. Rent was $250 million, now it's 180 million. Their expenses went down a lot as well, from $500 million to $250 million. The reason their net income is negative was a big impairment of 137 million and a loss from equity interests, 400 million. So their loss from equity interests is solely due to Steward. They wrote down 411 million. So they decreased their rent payments 411 million and passed to a loss onto their income statement. They're not getting that money. The only way to help Steward stay afloat is its creditors have to take a haircut. Let's look at a stock on Simply Wall Street. Its last price, $451, 2.8 billion market cap, down 2.5% in the past week, down 17% in the past year. Here's the stock price since they started trading in 2005. It did get down to below $3 in 2009, and it peaked at 24 in the beginning of 2022. But as you know, since the beginning of 2022, the stock has come down a lot. Steward filed bankruptcy this year, so why did the stock go down so much in 22 and 23? Because the writing was on the wall. People knew, analysts knew, that this company was going to need to take a haircut at some point. It's kind of like being in a bad relationship. Just because you don't get along doesn't mean you get divorced the next day. Sometimes it takes years and years to get divorced. So bankruptcy doesn't come right away. There's a lot of pain and suffering prior to bankruptcy. Bankruptcy is like the final step. It's like divorce. Simply Wall Street values the stock at $6. They say they're 25% undervalued. 8 analysts priced this stock at $5.13. They also say it's undervalued. Their revenue back in 2013 was $250 million. And look how much it grew from 2013 to 2022, up to $1.6 billion. Then the pain set in, and they weren't receiving full lease payments from Steward, and their revenue came down a lot. They also sold some properties as well. This red line is their debt. It was $1.4 billion in 2013. The peak was over $11 billion in 2021. It's down a little bit. It's $9.4 billion currently. But it doesn't look that bad because their equity is tracking their debt. Now their debt is a little higher, but they do have a good amount of equity. a lot of real estate on their balance sheet. And they don't keep much cash on their balance sheet, only $600 million. Here's their dividend yield since 2014. It was 5.9%, and it stayed in that range for a while. Then it shot way up when the stock crashed, over 14% in 2023. They cut their dividend, still pretty high though. This says 6.3%. The forecast is 11% by 2026. From 2014 to 2023, they consistently raised their dividend, but then they cut it a lot in 2023 to 15 cents, and they missed a dividend right here, and they cut it again. This most recent dividend was 8 cents. The CEO's salary was $1 million in 2017, still $1 million currently. At least somebody's making money with this company. It's definitely not the shareholders. Total compensation $18 million, tenure as CEO 21 years. In the past year, there's been some insider buying and selling. Michael Stewart, no relation to Steward Healthcare. It's also spelled differently. 64% of the company is owned by institutions, 22% by the general public, and 14% by insiders. The biggest shareholder is Vanguard at 15% and BlackRock. Schwab owns 1.7%. The CEO owns 0.8%. Their employee count is up. It was 38, now it's 121. REITs don't really need a lot of employees. The hospitals they own have a lot of employees, but those employees are not part of this REIT. They don't work for this company. And the ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, Bulgaria, and Sao Paulo Bolsa. So if you want to get really, really good at understanding financials, picking apart the income statement, balance sheet, and statement of cash flows, click on the video in the top right corner. Thanks for watching.